But yesterday was a pause for the US market, was a pause for our market, and everybody's asking whether this global pullback rally can extend much more from here. Let's now talk to the fund manager who runs the world's largest BRICS fund. Allan Conway of Schroder's Investment Management is with us. Allan, thanks very much for joining in. What's your take on this current global equity pullback that we've seen so far?
I think we should remember that significant rallies during bear markets are not uncommon. If you think about the US in the 1930s or Japan in the 1990s, you had most years at least one or more significant rally of 20 or 30% or more. This is quite common. And the magnitude of this rally, therefore, is perfectly in line and consistent with those sorts of bear market rallies we've had in the past. We believe that this is a bear market rally, and it's too early to think that we're now into a new bull market.
If that is the case, Allan, would you say we've also perhaps put the best of the price performance behind us, or do you think this bear market rally can surprise with how much we gain?
Well, in terms of, it's already been a very significant rally. One wouldn't think that there's going to be much more left in it from here. It's always very difficult to fine-tune these things, but given the magnitude of the rally that we've had, some markets like Russia, for example, over the last 4 weeks or so is up some 40%. So I think that would be as much as you could expect. There might be a little more, but we wouldn't expect much more from here.
After this rally is done, if it's done somewhere around these levels, as you say, Allan, do you see the prospect of another leg down or even a retest or a breach of the recent bottoms we put in place?
Well, it's not impossible that we retest lows again. The problem is that there is massive uncertainty about how the global economy is going to work through from here. The general consensus is that there will be an anemic recovery next year, and we'll start to see evidence of this later on this year. Now, if that happens, we may well manage to avoid retesting lows. So you'll get a pullback, but it may not be that significant. The risk is that this recession that we're in turns into a depression, which would then have not just negative growth this year, but also negative growth next year. And were we start to take the view that next year was going to be negative as well, and this really was a depression, then absolutely you would see these lows retested. So we have to really wait for a higher degree of confidence about whether this is going to be simply a deep recession with recovery next year or a depression.
What's also happened these past few weeks, Allan, is that there's been talk of risk aversion opening up and interest coming back to emerging markets. How do you read that?
Well, it's very interesting. We have seen a significant pickup in interest in emerging markets over recent months, particularly from institutions. It's interesting to note that, last year people said emerging markets underperformed the developed last year. Therefore, the decoupling story has been proven to be a myth. And we've always disagreed with that. Decoupling is not a myth. Decoupling is fact. And you see that primarily in their economies. The economies have clearly decoupled. Emerging generally this year will still overall show some positive growth, while the OECD is deeply negative. China will come in with 6% plus growth this year. The stock markets last year didn't decouple, but that was a function of technical factors and liquidity. This year, emerging once again is significantly outperforming, and that's what you should expect because the emerging economies themselves are so much stronger. That's one of the reasons why we've seen this pickup in interest from institutions. Most investors are underweight emerging. We had a massive sell-off last year where people pulled money out of assets, equity markets generally, and they particularly sold emerging because the sad truth is that over the last 11 years, investors in the developed equity markets, US, Japan, Europe, have actually lost money. In emerging, even after the setback, they're still up some 140, 150%. So last year, when investors became cautious, They wanted to raise liquidity. The first place you'll look to raise liquidity is where you have profits. Investors over the last 10 years have lost money in the US, Japan and Europe. They still had profits to take in emerging. So emerging got sold off because investors went cautious. That's left most investors underweight emerging. If you look at the MSCI World, an investor using that index needs about 10% in emerging to be neutrally weighted. Most investors are underweight. And not only that, in the current situation, the emerging economies are much, much stronger than the developed. So confronting this problem, they have stronger reserves, stronger current and fiscal positions, stronger underlying economic growth, and the valuations today at about 9 times prospective PE are very attractive. So investors are starting to return to this asset class.
Okay, you're positive on emerging markets, Allan, but put India in the context. What's your outlook on India from the current levels?
Well, you know, India's an interesting one for us. You'll recall in various discussions we've had with you over the last couple of years that for the whole of 2008, indeed into the last part of 2007, we were increasingly sceptical about India. In our view, India had become a bubble, and you may recall in previous interviews we'd described India many times as a bubble, which was very embarrassing because the bubble kept getting bigger and bigger. But there you are, you can't get the timing absolutely right. But of course that bubble has largely burst now. The Indian valuations have come down significantly, more than halved. India is now on a prospective P of about 10 times, which is about 10% premium to other emerging. But at least India is showing stronger growth. We're talking about positive growth this year in India against negative in many of the developed countries, as we know, and some Asian emerging markets will be negative this year. But India is positive. So the valuations are attractive. There is still growth there. It has some negatives. Obviously, the fiscal situation isn't as strong as you would have liked. It's one of the more problematic areas. The level of reserves aren't as high. But nevertheless, relative to many emerging, India is starting to look more attractive, and we're starting to see value. As a result, we have moved India up to neutral, which, having been underweight India for over a year, is quite a significant development. And we could actually see, as this year progresses, the potential for India moving overweight.
The first few months of the year, though, Allan, have been very unlike the kind of prognosis people had set out. What do you see as the final outcome for markets generally by the time we're done with 2009?
That, of course, you know, is any number I give would have a huge range of spread around it. We believe that, given the current valuations and the strong economic fundamentals in emerging markets, that we can see a good positive return this year. It all comes down to just this one question. Are we going to get this anemic recovery next year and see us coming out of recession, or do we move into a depression scenario? If it's the former, which is the likely outcome, then emerging this year should provide investors with actually a very nice return. If, on the other hand, this turns out to be a depression with negative growth next year, then basically you don't want to be investing in equity markets anywhere, emerging or developed. You want risk off the table. It comes down to your view on where the global economy is going. Our central view, our probable outcome, is you do get this recession giving you coming out of recession giving you an anemic recovery, in which case definitely you should be putting money into emerging markets now.
Allan Conway, we do appreciate you joining in today. That's the Schroder's view, very, very important for emerging markets like ours. Let's take a